Okay, picture this. Truly passive income from real estate.
Yeah.
Where money just shows up month after month, minimal fuss.
Right. The dream scenario.
Exactly. And triple net lease investing, or NNN, well, it's often touted as like the premier way for passive income seekers here in the US to maybe get their financial freedom, building wealth, all that.
Mm-hmm. It sounds simple on the surface.
Almost too simple, maybe. Find a property, tenant signs this NNN lease, pays everything, taxes, insurance, maintenance, and you just, collect checks?
Yeah, that's the glossy picture. But like most things that sound that easy, there's definitely more to it. Complexity hidden underneath.
Which is why we're doing this deep dive. We got this great stack of source material from a listener who's really thinking about this NNN path, specifically buying properties right here in the U.S.
Excellent. So we're using that as our guide.
We are. We're going to pull out the key stuff, the warnings, the steps you absolutely need to know, all based on these documents.
And that's critical because, look, the promise of stable, predictable, passive income from NNN, it's real. But getting there, that depends completely on the work you do before you own anything.
Right. It's not quite set it and forget it during the buying part.
Not at all. It demands serious analysis, investigation up front, rigorous work.
Okay, so our mission today, using these sources, is to really unpack NNN investing for you. We'll start with the basics. What is NNN? How's it different from other leases?
Good starting point. Define the terms.
Then we'll dig into why it's so appealing. Stable returns, those tax advantages everyone talks about, that's all in the material.
But we won't sugarcoat it.
No way. We have to talk about the risks, the things that can turn that passive dream into, an active nightmare.
Very active.
And then the main event, really, the shield against those risks.
Yeah.
That comprehensive due diligence, the physical, financial, legal detective work you have to do before you sign anything.
Yeah, we'll walk through the whole landscape. Demystify things like cap rates, talk tenant strength, huge deal, expose the risks, and then break down that due diligence step by step using the details from the sources.
All right, let's jump in. We hear triple net lease, NN, but also N and NN. What are these? How are they different? Seems like everything builds on this foundation.
Perfect place to start. So triple net lease, NNN. Basically, it's a commercial lease where the tenant pays rent, obviously, but also takes responsibility for three main property expenses, the ones a landlord might traditionally cover.
Okay, the three nets.
Exactly. Those are property taxes, building insurance, and maintenance costs, upkeep, repairs, that sort of thing.
So the tenant's really shouldering the operational weight.
Precisely. It shifts most of those variable, day-to-day, sometimes even bigger operating costs onto the tenant. That's what makes it attractive from a management angle.
Makes sense.
Now, like the sources mentioned, it helps to compare it. You said single net, N. With an N lease, tenant pays rent plus property taxes. That's it. Landlord still handles insurance and maintenance.
Okay, just one net added.
Right. Then you get double net, N. Tenant pays rent, taxes, and insurance. But the landlord, usually still responsible for maintenance, especially the big structural stuff, roof, foundation.
Ah, okay. So structural maintenance is often the landlord's job, even in NN.
Often, yeah. And the material points out something interesting. Sometimes a landlord might even prefer an NN lease for a newer building, less worry about immediate major repairs. Maybe they can get slightly higher rent by keeping that responsibility.
So NNN adds that last N maintenance to the tenant's duties.
Correct. But wait, there's another layer the sources mentioned. Even within NNN, there's standard NNN. Tenant handles most maintenance, but maybe big structural things like a roof replacement might still be the landlord's job. Depends on the exact lease wording.
Ah, the fine print matters.
Always. And then there's the really hands-off version, absolute triple net, sometimes called a bondable lease. Here the tenant pays for literally everything, including major structural repairs, roof, foundation issues, stuff that's almost always the landlord's problem otherwise.
Wow, absolute NNN. That sounds like the ultimate set it and forget it for the landlord.
It's the purest form, yeah, though less common than standard NNN.
Oh.
And then way on the other end of the spectrum, you've got the gross lease.
Right, the opposite.
Totally. Landlord pays all operating expenses, taxes, insurance, maintenance, maybe even utilities. They just charge a higher base rent to cover it all.
Yeah.
Tenant pays one flat rate.
Yeah.
Simple for the tenant, but the landlord manages and absorbs all those fluctuating costs.
Which is exactly what NNN avoids by pushing those variables onto the tenant. Creates that predictability.
That's the core idea, predictability.
In that predictability, that shifting of responsibility, it sounds incredibly attractive for passive income seekers. Why does NNN get called a passive income secret sometimes? Why is it so popular for U.S. investors?
It gets that reputation because it offers that potential combo. Stable, predictable income, and much lower management effort compared to, say, running an apartment building.
Right. Less hassle.
Way less hassle, potentially. The lease terms, usually very long. We're talking 10, 15, often 20, 25 years, sometimes even 30. That's a long, stable income stream locked in.
Decades, potentially.
Yeah. And because the tenant handles those variable costs, taxes, insurance, maintenance, your net operating income, your NOI, becomes much more predictable. It's basically just that base rent coming in. That stability is huge, especially for retirement planning, like the sources mentioned.
It really does sound like set it and forget it, at least after you buy it.
Largely, yes, after the acquisition. The sources stress the low management requirements. Routine repairs, landscaping, parking lot sweeping, paying the tax bill, tenant handles it. Contrast that with, high-touch properties, apartment buildings, constant tenant calls, collecting rent from dozens of people, repairs, turnovers. Right. Or even multi-tenant retail. NNN, especially with a strong single tenant, is great for busy people, retirees, folks who live far away, or just anyone who doesn't want to be an active property manager.
Makes sense. Beyond the management side, the sources really dive deep into tax advantages. What's special about NNN there?
Oh, this is a major piece, huge appeal. The sources list several key benefits. First, depreciation deductions. You depreciate the building structure itself over 39 years for commercial property. Standard stuff.
Okay.
But the material also notes you might be able to depreciate other things. Faster roads, maybe some machinery or appliances the tenant uses that you own, other improvements. And they specifically mention cost segregation studies.
Cost segregation? What's that?
It's a way to accelerate depreciation. You hire specialists who analyze the property and reclassify certain components, maybe carpeting, certain fixtures, landscaping, into categories with shorter depreciation lives, like 5, 7, or 15 years instead of 39.
Ah, so you get bigger tax write-offs sooner.
Exactly. Bigger deductions early on, which lowers your taxable income in those initial years.
Yeah.
Very powerful. Then there's the 1031 exchange. Huge deal in real estate.
1031, right. Heard of that.
Under the IRS code, it lets you sell an investment property and defer 100% of the federal capital gains tax and depreciation recapture tax if you reinvest the proceeds into another like-kind investment property within specific timeframes.
So you can trade up without paying taxes on the sale?
Pretty much. And it's super relevant for NNN because you could, say, sell a high-management apartment building you've owned for years, take all those gains and roll them tax-deferred into a low-management NNN property. You can keep doing this, potentially upgrading properties over your lifetime, maybe even passing them on, all while deferring those taxes. It's a major wealth building tool.
Wow. Indefinitely deferring taxes. That's powerful.
Very. The sources also mentioned the potential for the qualified business income or QBI deduction. That's up to 20% off qualified income. But
there's a catch.
It's tricky for NNN, as the material warns. It depends if the IRS sees owning and leasing that NNN property as a real trade or business under Section 162. If it's truly passive, like really hands-off, it might not qualify. Definitely need a tax advisor on that one.
Okay, noted. Professional advice needed there.
Absolutely. And there's another slightly confusing point the sources bring up. Sometimes the IRS or courts might view NNN leases as uniquely tax-free for the owner compared to other lease types. Now, this isn't magic.
Doesn't sound like it could be.
No. It relates to how income is reported. In a gross lease, the landlord gets higher rent than pays expenses.
Right.
Their gross reported income is higher. In NNN, the tenant pays many expenses directly, so the landlord's reported rental income is lower. The net realt might be similar, but the structure affects the reporting.
So it's about how the cash flows and gets reported, not a secret tax loophole.
Exactly. Just another reason why the specific lease and your specific tax situation need professional eyes on them.
Got it.
Structure matters for reporting. Okay, beyond income and taxes, what about diversification? Does NNN help there?
Big time. Real estate itself is a tangible asset. It behaves differently than stocks, bonds. Good inflation hedge, usually less volatile than the stock market.
Right. Something solid.
And within NNN, you can diversify more. Invest in retail or industrial warehouses, medical clinics, office buildings, different sectors, different parts of the country. The sources use a great example. Owning NNNs leads to essential businesses like grocery stores or pharmacies. Those tend to do well even in downturns, right? A nice balance to maybe riskier tech stocks in your portfolio.
Yeah, people always need groceries and prescription.
Exactly. So NNN can be that dependable pillar, providing consistent cash flow in a broader investment strategy.
That makes a lot of sense. Tangible, less volatile maybe, predictable income. Sounds like a solid portfolio piece.
That's the allure. But figuring out if a specific NNN property actually delivers on that promise and fits your goals, that requires understanding how we measure its value and return potential. And the key metric, cap rate.
Ah, cap rate. Comes up in every commercial real estate talk. What exactly is it, and why is it so vital for NNN investors?
Capitalization rate, or cap rate. Think of it as a snapshot. It measures the potential rate of return based on the property's income. It's basically the yield you'd get if you bought it all cash, no loan involved, a tool to gauge profitability, compare deals.
So like the unleveraged return percentage.
Exactly that. Formula's simple. Cap rate equals net operating income divided by purchase price, then multiplied by 100. The sources give an example. Property makes $130,000 in NOI a year. Price is $2 million. So $130,000 divided by $2 million times 100. That's a 6.5% cap rate.
Okay, 6.5% return before financing.
Right. If for every $100 you put in cash, you'd expect $6.50 back in annual NOI.
Simple math, but seems crucial for NNN. Why?
Because with NNN, the NOI is usually just the base rent, pretty much.
Yeah.
Tenant pays the other stuff. So the cap rate is a really clean measure of income efficiency versus cost for NNN. It helps investors in a few ways. First, risk evaluation. Generally, lower cap rate means lower perceived risk.
Lower cap, lower risk, like 5%.
Yeah, maybe 5%. Prime location, long lease, super strong tenant. Higher cap rate, say 7% plus, usually signals higher risk.
Yeah.
Weaker tenant, maybe. Shorter lease, less desirable spot. You might get a higher return, but you're taking on more risk.
So higher cap isn't automatically better, just riskier.
Exactly. The market's demanding more return for that perceived risk. Second, comparison. Cap rate gives you a standard way to compare different NNN deals. Different locations, retail versus industrial, different tenants, quick first look. Third, forecasting. Helps estimate if the potential return meets your goals.
What makes cap rates move up or down?
Lots of things. Big economic factors, definitely. Interest rates are huge. Like the sources mentioned for 2023-2024 when interest rates went up. That pushed cap rates up too.
Wow.
Because if it costs more to borrow money to buy the property, investors need a higher return from the property to make it worthwhile. Or they need it to compete with safer investments like bonds, which are also yielding more when rates rise. Inflation matters too. High inflation, investors might want higher caps to protect their buying power.
It makes sense. Cost of money goes up, required return goes up.
Exactly. Location, paramount. High demand areas, lower caps. Declining areas, higher caps. Lease length, big one. 20 years left on the lease. Lower cap in the same place with only 5 years left. Less near-term vacancy risk.
And tenant quality. You said that was huge.
Massive, maybe the biggest driver. Critical point from the sources. Property leased to an investment-grade tenant, think CVS, Walmart, FedEx, commands a lower cap rate.
Yeah.
Maybe 5%, 5.5%. Why? Because that income stream feels super safe, reliable.
Okay, strong tenant, lower cap.
Yep, property leased to a smaller company, a non-investment grade tenant, or maybe a local business, a franchisee, without a corporate guarantee. Higher cap rate, maybe 6.5%, 7.5%, even higher, compensates the investor for the higher risk that tenant might default.
So the market literally prices the tenant's default risk into the cap rate.
Directly. And finally, the lease details matter, especially rent increases or escalations. A property might have a slightly lower starting cap, but if the lease has strong guaranteed rent bumps built in, maybe tied to inflation, CPI, or a fixed 1.5%, 2% a year, that future income growth makes the initial yield more attractive long-term. Could justify a lower cap compared to a lease with flat rent.
Okay, so when you're looking at NNN deals, how should you use the cap rate? Just grab the highest one.
Definitely not. Highest cap often means highest risk. It's a starting point, a comparison tool. Needs context. You got to ask, does this cap rate make sense for this location, this tenant? Is the lease long enough? Are the rent bumps decent? How does it stack up against similar NNNs that just sold nearby?
Compare apples to apples.
Exactly. And like some sources suggest, how does this potential risk-adjusted return look compared to other things you could invest in? Stocks, bonds. The cap rate is a quick check, a market signal. It doesn't tell you your actual return if you use leverage or account for timing. Other metrics like IRR are better for that. But as a first filter, indispensable.
Got it. Crucial info, but just one piece of a bigger puzzle. And speaking of that puzzle, tenant quality. Massive factor for cap rate and risk. Let's spend some real time on that. How do you figure out how strong a tenant really is? Sources say this is maybe the most critical part.
Cannot stress this enough. Single tenant NNN. The tenant is the investment. Tenant fails. Income stream vanishes. Zero. The source is blunt.
Biggest risk in NN is tenant default. Bankruptcy.
Right.
Picture it. National chain leasing, your building goes bust. Suddenly, 100% of your rent gone overnight.
And you're still on the hook for the mortgage, taxes, insurance, everything the tenant used to pay.
Absolutely. Like one source says, if it's financed, the bank still wants their money every month. Now it comes out of your pocket. That passive dream, poof, evaporated. Now you've got carrying costs plus the hassle and expense of finding someone new. And that vacancy could easily be 6 months, 12 months, even longer.
Ouch. Okay, so how do you gauge the odds of a tenant not defaulting? That's where credit ratings come in. For the big public companies, yes. Credit ratings from S&P, Moody's, Fitch, they're like expert scorecards on a company's financial health. Their ability to pay their debts, including rent. They look at everything: revenue, debt, profit, cash flow, market position, industry outlook, and assign a grade. AAA is best, D is default.
And the key dividing line is investment grade versus non-investment grade.
Fundamental concept. Investment grade, typically Bay3 or higher from Moody's, BBB or higher from S&P Fitch, means relatively low default risk. Leasing to one signals stability, results in lower cap rates, higher property value. These are your blue chip tenants often.
And non-investment grade is below that threshold.
Correct. Below Bay3 BBB, higher risk of financial trouble, potential default, often called junk status, though that's a bit harsh sometimes. Properties leased to these tenants, higher cap rates, compensates you for the extra risk. Potential for higher yield, sure, but higher chance of problems.
Okay, clear for big public companies. But what about smaller chains, private companies, franchisees? No public ratings there. How do you check their strength?
Yeah, this gets trickier. Often needs expert help, like the sources mentioned. No easy public rating. You got to dive into their actual financial statements, audited reports if possible, income statements, balance sheets, cash flow statements. You need to analyze their revenue trends, profits, debt levels, and critically, their liquidity. Do they have cash to pay the bills, including rent?
So you basically become a financial analyst for that specific business.
Pretty much, yeah. Or you hire one. You compare their numbers to industry averages. Are they healthy compared to peers? The sources specifically flag analyzing income and EBITDA. Earnings before interest, taxes, depreciation, amortization.
Why EBITDA? Why is that so important?
Because it gives you a clearer picture of the business's actual operational cash flow before financing costs, taxes, or non-cash stuff like depreciation muddy the waters. It answers, can this business generate enough cash from operations to pay the rent comfortably? Super critical for private tenants, especially cash-heavy businesses like, say, fast food restaurants, QSRs.
That's way deeper than just looking up a rating online.
It is. And you also need to know about the lease guarantee. Is the parent corporation guaranteeing it? Or just the individual franchise operator? Big difference. A corporate guarantee from Starbucks is worth a lot more than a personal guarantee from Joe franchisee who might not have deep pockets.
Okay. How does all this, the tenant's credit strength or lack of it, affect the property's value in getting a loan?
Huge impact. Stronger tenant credit, lower cap rate. Lower cap rate directly means higher property value. Simple math. A 5% cap property is worth way more than the same property at a 7% cap. Also affects resale value later. And liquidity properties with strong tenants are easier to sell. More buyers are interested, including big institutions. And financing. Lenders love strong tenants, investment-grade tenant. Lower risk for the bank means better loan terms for you, lower interest rates, maybe more money lent against the property value, higher LTV, smoother approval, non-investment grade or private tenant. Lenders get cautious. Might mean higher rates, bigger down payment needed, or it could even be tough to get financing at all.
And you mentioned something earlier that really stuck out: cash sweep provisions, especially with CMBS loans. How does tenant credit trigger those?
Yes. Crucial, often overlooked detail from the sources, especially with CMBS loans, commercial mortgage-backed securities. These are complex loans, often for bigger properties, bundled and sold as bonds. Because the bondholders are far removed, the loans have extra protections built in. A common one, a cash sweep if the tenant's credit rating drops. Often specifically triggered if they fall from investment grade to non-investment grade.
So what happens in a cash sweep? The lender sweeps the cash.
Literally. When it's triggered, the tenant's rent payments, they don't come to you, the owner, anymore. They get diverted, swept directly to the lender, or a special reserve account the lender controls.
Oh.
Yeah, that cash might just sit in reserve, or it might be used to pay down your loan principal faster, even if you're current on your payments. It completely changes your cash flow. A tenant downgrade can also trigger other bad stuff, and the loan agreement demands for more reserves, higher interest rates, maybe even loan default in severe cases.
Wow. So the tenant's financial health, even after you buy the place, can mean you don't even get the rent money. The lender takes it first. That really hammers home why tenant strength isn't just theoretical risk, it's direct financial impact.
Perfect example. That passive income totally relies on the tenant staying healthy. And understanding risks like these. That's why you have to look under the hood with NNN, because the appeal is strong, but the potential pitfalls also very real. You need to know them and guard against them.
Okay, let's face those pitfalls. We know tenant default is number one. Just remind us how bad that is in a single tenant situation.
Worth repeating, it's the core vulnerability. Single tenant, NNN. They go bust or just leave. Income drops 100% to 0% instantly. But your expenses, mortgage payment, property taxes, insurance, those continue. Now you pay out of pocket. Unless you have huge reserves, that can sink you fast.
And finding a new tenant isn't always quick or easy, especially for certain buildings.
Heck no. Vacancy can drag on. 6 months, a year, easy, sometimes longer. And getting a new tenant can cost a fortune. Think about specialized buildings, a fast food joint with drive-through and kitchen, a bank branch with vaults, an oil change place with pits.
Right. Not just any business can walk in and use that space.
Exactly. You might have to spend serious money gutting it or building it out for someone new. Major capital expense, all while getting zero rent.
So the specialization is great when occupied, a real headache when vacant.
Double-edged sword, for sure. Another huge risk, market and location. Even a rock-solid national tenant can struggle or just decide not to renew if the neighborhood goes downhill. Demographics change, economy tanks locally, new competitor opens up, and if they leave. The sources had that great, very specific example.
Oh yeah, the Artesia, New Mexico one.
That's the one. A vacant building that was previously home to Tractor Supply or Dollar General is incredibly difficult to release at the same rent if it's located in Artesia, New Mexico.
That really paints a picture. Location isn't just about today, it's about the future if that space becomes empty.
Precisely. Vacant building in a weak market. Very hard to release, might have to slash the rent, might sit empty for ages, kills the property value. Good locations, high traffic, strong demographics, growing area, offer downside protection. The location itself has value, attracts more potential tenants if the current one leaves.
So analyze the market as much as the tenant. What about the lease itself? That long term, can it bite you?
Absolutely. Stability is great, but long leases, 10, 20, 25 years, mean inflexibility. You're locked in. What if market rents shoot up way faster than your little 1% annual bumps in the lease?
You fall behind.
You fall behind. Your real return gets eaten by inflation. You're stuck with below market rent for years. Feels bad. And trying to sell mid-lease can be tricky if the terms aren't great. The sources also mention as the lease gets close to expiring, property value often dips. Vacancy risk is looming.
And renewal time can be tough.
Yeah, the tenant might have leverage, especially if their current rent is above market now or if they know you really don't want a vacancy. They might demand big bucks for renovations funded by you or demand lower rent. Put you in a weak spot.
Okay, major risks. Tenant failure. Hard to release buildings. Bad location risk. Getting stuck with inflexible under-market leases. Serious stuff.
They are. And navigating all that, making the passive dream real, requires that active, upfront process, due diligence.
Right, let's talk about that shield, due diligence. Why is it so vital? Why can't you just skim it or treat it like a box-checking exercise in NNN?
Because due diligence is your investigation time. It happens after you agree on price, but before the deal is final, non-refundable. It's your chance, your obligation, really, to verify everything. Property, tenant, lease. That is what they claimed, was how you find hidden problems, confirm the good stuff, make sure you're getting what you paid for. It identifies issues, physical, financial, legal, that could wreck the investment. And, as material notes, you usually don't do this alone. You need experts, access.
So it's like a forensic audit of the whole deal before you're fully committed.
Exactly. The purchase contract gives you a set time, the due diligence period, often 30 days, maybe more.
Yeah.
Buying is contingent on you being satisfied. Find a huge problem, bad roof, cooked books, environmental mess, you can usually walk away, get your deposit back. It's your safety net.
The sources break it into 3 pillars: physical, financial, legal. Let's unpack those. Physical due diligence first.
Physical DD is about the actual building, the land, the systems. More than just a home inspection. You're checking structural integrity, roof, foundation, walls, windows, inspecting major systems, electrical, plumbing, HVAC, looking at the parking lot, landscaping, lights, signs. You want reports like a property condition report assesses a state, flags needed repairs or future costs. Maybe soil reports, structural reports if needed. When were things last replaced or renovated? Termite checks, standard. Maybe look at old appraisals for notes on condition.
So understanding the building's health now and predicting future needs.
Exactly. Even with NNN, remember, major structural stuff might still be your problem depending on the lease. You need to know the condition. The sources also add a critical piece here, a market comparison survey. This isn't just the building itself, but how it stacks up physically against competitors nearby.
Okay, how does it compare?
You research similar properties nearby that recently leased or sold. Look at their size, age, condition, amenities, parking, rent rates. Helps you see if your property is competitive physically. Is the current rent fair for what it is? Gives you ammo for thinking about future rent potential. Or confirms if it's performing as expected versus the competition.
Connects the physical asset to its market position. Okay, financial due diligence. Verifying the money side.
Right. Digging into the income and expenses. Verifying what the seller told you. You get the current rent roll, who's the tenant or tenants, lease start end dates, rent, escalations, everything. You look at rent collection history past year or two, any late payments, delinquencies. You review accounts receivable, accounts payable for the last couple of years.
Like an accountant digging through the records.
Totally. You get income and expense statements for the property, maybe last 3 years. Get the owner's property tax returns for those same years to cross-check. Look at the current operating budget. Any projections, though, you'll likely build your own realistic ones based on verified data. If the physical inspection found needed repairs, get contractor quotes now. Build a rehab budget. Verify the actual property tax bills, current and prior year. And critically, read every lease, every addendum carefully. Check expiry dates, especially if near. Check security deposits. Confirm they're signed. Any weird concessions or incentives given to the tenant. Contact utility companies yourself. Get actual historical costs. Don't just trust seller numbers. And obviously, getting your final loan approval from your lender. That's a critical financial DD step 2. Has to happen in this period.
Feels incredibly detailed. Third pillar, legal due diligence.
Legal DD covers the property's legal status, compliance, and making sure you get clean title. First thing after contract, get it to your attorney, lender, title company. Send your earnest money deposit to the title company. Big focus. The preliminary title report shows ownership history, flags any liens, easements, restrictions, other title issues. You work with the title company, your attorney, to clear any clouds before closing. Then you get title insurance, protects you financially if some hidden title defect pops up later.
What are you mainly looking for in that title report?
Liens.
Yeah, lien-ins are huge. Mechanics lien-ins, unpaid contractors, tax lien-ins, judgment against the owner. Anything that could stop you from owning it free and clear. One source specifically warns liens can hold up closing. You also get an updated property survey.
Survey came up under physical, too. What's its legal role? Good catch. Bridges both. Physically, shows boundaries where buildings sit. Legally, confirms improvements meet zoning setbacks. Building isn't too close to the line. Identifies encroachments you're building on neighbor's land or vice versa. Details easements, legal rights for others, like utilities, to use part of your land. You need to understand all those limits and rights.
And if the survey shows a problem, like an encroachment?
Attorney investigates. Is it grandfathered? Meaning it was legal when built under old rules, allowed to stay even if it violates current rules. If yes, probably okay for now. But crucial point from the sources, if you ever wanted to rebuild or significantly alter it, you'd likely have to meet the current, maybe tougher zoning rules. Could limit future redevelopment. Important nuance for long-term value.
Key point. Grandfathered isn't a free pass for future changes. What other legal checks?
Environmental compliance. Non-negotiable. Get a Phase 1 environmental site assessment. Mandatory. Researches history, checks databases, inspects the site for recognized environmental conditions, or RECs, signs of potential contamination, old gas station, dry cleaner, industrial use.
Okay, what if the Phase 1 finds something?
It recommends a Phase 2. That means physical testing, drilling, taking soil samples, groundwater samples, looking for actual hazardous stuff. If Phase 1 finds RECs, you need that Phase 2 done and cleared, or understand the massive liability you might inherit. Inheriting a contaminated site. Nightmare. Huge cleanup costs, legal trouble. Usually a deal breaker unless the seller fixes it completely before closing with proof.
Sounds like a risk you just don't take. Ever.
Pretty much.
Huh.
You also review existing service contracts, trash, landscape, HVAC. Do you have to take them over?
Sure.
Get copies of all licenses, permits, certificates for the property's use. Are they current? Transferable. Review warranties on building parts. Verify current use matches zoning. Check for outstanding building code violations, legal disputes.
Okay, that list makes it clear. There's a lot to check beyond just, does the tenant pay rent? Let's drill down on a few specific actions the sources highlight. First, reviewing tenant financials, especially for private ones.
Right. Public investment grade company. Easier. Check their ratings. S&P, Moody's. Look at their public financials online. Pretty straightforward. Private companies, franchisees. Much harder. No public ratings. Your advisor needs to analyze their private financial statements. Income, balance sheet, cash flow, line by line. Understand revenue, expenses, debt, and critically, liquidity. Calculate key ratios compared to industry benchmarks.
And that focus on EBITDA for private companies.
Yes, specific call out in the sources, especially for operating businesses like QSRs. EBITDA shows the raw operational cash generation, stripping out financing, tax, non-cash items. Can the business comfortably cover rent from its operations? That's the core question. Also vital. Is the lease guaranteed by the corporation or just the franchisee? Requires real business financial analysis expertise.
Really shows you need to understand the tenant's business, not just their rent history. What about the lease review? Sources say, read every word. What exactly are you looking for?
The lease is the rule book for your investment. Your lawyer needs to dissect it. You need answers beyond rent and expiry. Is it truly absolute NNN? Tenant pays for roof replacement. Or standard NNN, where that might still be on you? Is there a strong corporate guarantee? Or just a weak franchise one? Rent escalations, are they good enough? Fixed percent. Tied to CPI, how do they work? If lease end is near, how does rent compare to market rates now for similar spaces? What are the renewal option terms? Crucially, what are the landlord's duties in the fine print? Any hidden responsibilities? How do reimbursements work? Tenant pays taxes, insurance, CMAM, are the procedures clear? Timelines. True-up process for reconciling estimated versus actual costs. Termination clauses. Can the tenant bail early? Under what conditions? Assignment clauses. Can they sublet or assign to someone else? Do they stay liable? What are the requirements for a replacement tenant's finances if they assign? Sources stress this is critical for franchise leases, prevents a strong tenant swapping in a weak one.
So the lease defines your passive role in the income strength, not just a form.
Far from it. Every clause counts. Another drill down. Title review and easements. Check and clear ownership, yes, but also looking for CC&R's covenants, conditions, restrictions. Could limit the business type allowed, maybe to protect another tenant in the center via an exclusive use clause. Overly strict restrictions could kill your releasing options later if the current tenant leaves. Understand future use limitations. Easements, who has rights to use your land. Understand the impact. And CAM charges, if advertised as NNN, make sure the lease says tenant reimburses you for CAM. They don't just pay some direct costs.
Checking for those future use restrictions seems vital. Phase 1, environmental, you stressed it, but let's hit it one more time. Why this specific check?
Environmental DD, absolutely critical. Your advisor usually handles coordinating it. Phase 1 is step 1. Identifies potential contamination risks. RECs. You want a clean report. If it finds RECs, maybe it was a gas station, dry cleaner, had underground tanks. Phase 2 is needed. Physical testing, soil, water, looking for hazardous stuff. You must review any prior Phase 2 reports. If Phase 2 is recommended now during your DD, understand the cost, timeline. Advisor gets bids, inheriting contamination, potentially ruinous costs, legal hell. Almost always walk away unless seller cleans it up completely. Verified before closing.
Hits home, environmental risk, potential catastrophe. Lastly, the survey. Beyond encroachments and setbacks, what else does it confirm?
The updated survey confirms the exact legal description. Property boundaries. Shows easements, utility lines, access points. Legally, it proves the physical reality matches the legal description, helps find boundary disputes, also helps confirm compliance with some zoning rules like lot coverage or parking, though direct zoning code checks with the city are separate. But the survey, it's the foundational map. Everything else relies on knowing exactly what land and buildings you're dealing with. Standard, but essential legal and physical validation.
It sounds like every single step of due diligence, financials, physical check, lease reading directly tackles those risks we talked about earlier.
Exactly. Tenant financial deep dive. Addresses default risk. Physical inspection, market comparison. Mitigates property condition and releasing risk. Meticulous lease review. Protects against bad terms, low escalations, unclear duties. Title review, survey. Shields from legal issues, a lens, use restrictions. Environmental assessment. Guards against that catastrophic cleanup liability. Due diligence isn't just jumping through hoops. It's the active, essential work that builds the foundation for that passive income stream.
It's the shield that makes the passive dream possible, by finding and letting you avoid the potential nightmares.
Perfectly put. The necessary active effort to ensure future stability and reliability.
Okay, so if someone's listening, thinking NNN sounds like it fits their goals. Passive income, diversification. Based on these sources, what are the first steps?
Sources lay out a clear path first. Define your goals, honestly. Risk tolerance. Financial situation. How much capital do you have? Reserves needed. Income needs. Does the typical NNN return profile, maybe up to 8% annually with depreciation? Some sources suggest match what you need. NNN isn't for everyone. Goal clarity is step one.
Know thyself financially.
Then research property types, locations matching those goals. Look for busy areas, strong demographics, growing populations, locations that make sense for the tenant's business. Realize returns, cap rates, vary wildly based on location, building age, condition, even with similar tenants.
And research the tenant. Deep dive.
Absolutely critical. Review their creditworthiness. Public ratings for big guys. Deep financial analysis for private franchise tenants. Business stability, market position, credit history. Check that lease guarantee, corporate or franchisee. If multi-tenant, check anchor tenant health too.
And understand the lease, not just the summary.
Yes. Lease terms, escalations vital for long-term success, inflation protection, lease length, tenant duties. Truly NNN. Absolute NNN. Yearly expense reconciliations, true-ups, all crucial details.
Finally, the practical stuff. Financing and closing.
Get financing lined up early. Use lenders' experience with NNN deals. They understand it, might offer better terms if the deal's good. Gather your documents, then assemble your team for closing. Sources imply this. You need help. Advisor, lender, CPA, commercial real estate attorney, title company all play distinct, crucial roles in DD, financing, and ensuring a smooth, protected closing.
Clear that while the result might be passive income, getting there is active, needs a pro team.
The value of specialized advisors, experience specifically in NNN due diligence, cannot overstate it. They have the access, the expertise, they catch things you'd miss.
This has been a really comprehensive deep dive into NNN due diligence here in the U.S. We've clarified NNN, looked at why it's attractive, explored the very real risks, and walked through that essential physical, financial, legal investigation you need to do.
Yeah, understanding these upfront steps is absolutely vital for anyone serious about NNN for stable, long-term, genuinely passive income. It's the active work that makes the passivity possible later.
So here's a final thought to chew on from this deep dive. Considering how much really hangs on one tenant's financial health, the location's quality, and all those details buried deep in a complex lease, does this intense, active, often expert-led due diligence process change how you think about the word passive for NNN investing? Or does it just prove that the truly passive income is really the reward you get only after you've done the hard, active work up front to make sure the deal is solid?
Something to think about as you continue your own investment journey.
Thanks for joining us for this deep dive into NNN due diligence. Hope it sheds some light on the path and the critical steps involved in this very appealing but complex investment world.
Until next time.